Five, four, three, two, one. Earth below us. Looking at what is Robinhood trying to do to me? They put up my 10 credit spreads to close without even asking me. I mean, can't you just do me the courtesy and ask me? So I've got that 399/401, those call credit spreads. And so I clicked on it to try to cancel. Let me cancel and replace it. And it's basically saying, sorry, the robot has control of this order right now. So it's trying to pay $20. So it'd be 2 cents per, and that'd be $20 they'd be paying to get out of this trade, which would what? It would leave us with the $40 of profit, but I want all 60 if I can get it, right? I mean, we sold that for, where was it? It was 50? Was it $50? I say. How many contracts is it? Why are you confused again? You're always confused. It was right here, right? That's it. Those two. Yes, indeed. So you're saying that we collected only $50? So $50 we collected on those, and they're trying to close them. So that's the number that they're worried about, 399 strike. Let's look at SPY. I know it's been up lately over the last several minutes. It bounced up. It was at like 394.10, and then it bounced all the way up to 395.66. But that's still a long way to go if you want to rock and roll. It's still a long way to go to the 399. So why pay my hard-earned money to get out of that trade and take 20 of my $50 off the board? So I just wanted to check in and show you that. And then I had another thought. It's like a last minute thought with regard to this Google 2-option strategy. This Google 2-option strategy right here, right? Let's try to cancel again. Cancel the order. You're probably doing me a favor. Watch SPY just travel right up through that strike price. Anywho, back to this 2-option strategy on Google. Let's go back here. Let's do a little math. Make a little love, get down tonight. 92.47. So that's what we've paid, right? So on 100 shares, which would be one contract on a call option, that would be 92.47 would be 100 shares, right? So that would be our cost basis, $9,247. And then on that trade that is expiring in less than about 24 minutes right here on the Central Standard Time, we have this 2-option strategy. Both sides of this will be expiring. One side is going to expire at full price. That'll be this put, okay? The other side is this $99 call. Now, the reason I was going to let it ride was because our cost basis was $92.47. So I was going to let them basically take that away and pay me $9,900 to do so. Then I thought, there's no guarantee I can then take that $9,900 and turn it into more profit. There's no guarantee, but there might be a guarantee with rolling this side or buying it to close and opening a new position and rolling it up in strike price that we could lock in some more guaranteed profits on the same underlying asset. So I tried to trade these separately, but I think I need to buy this closed first, this $85 put. If I buy that closed, what will that do? Will that open up that other for a simple roll? So that'd be $1 it's going to cost me. We originally made $121 on this side of the trade, so that'll leave $120 in net profit. If we buy that closed right now, releasing $85 or $8,500, I should say. Okay, of course they took that. Why not take $1 when you're about to get nothing and like it? And then if we come back in here and we go to the call side, so we originally made 241 on it, 120 on the call side, 121 on the put side. So we just bought it back for $1. So we netted $120 on that. And then if we come back here and see what it leaves on the board as far as the Google. Okay, so now it has put that back out on its own. So it's at a $99 call on its own. Let me just peek back at the SPY. 395.62. They're still trying to close my position. Whatever, Robinhood. You're really making my butt stink. So let's go to this call and see if there's any math that we could use, because look, it's trading at $106 right now. So I'm essentially leaving $700 of profit on the table by not trying to roll this position into a higher number. But again, I'd be getting my $9,900 today that I can then deploy into other opportunities. But right now, we control this asset. We have it. We could still roll this position. What would we have to do to roll it into some more essentially guaranteed profits? So if we look out, let's see what we have to do to cover it first. So if we go out 2 weeks, well, 3 weeks to April 14th, and then we look at the numbers. So again, this is a $99 call that's currently on the table. How can we make more money and still cover that $690 debit? So we could go $1 higher to 100. So we can grab essentially another dollar on the share appreciation, so that we'd be $1 times 100. That's $100. We could also then add around $47, so that'd be $147 on. Now remember, this is a $9,247 investment. That's our cost, right? So let's see if any numbers make sense here. So we would be adding 100 on our upside, right? 100 from $99 strike to 100. That's $1 times 100 is 100. So $100. And then we would be adding the $53 credit, 53. Okay. So then we would be dividing that by our original cost, which was 92.47. So our return would be 1.6% in 21 days. So if we divide that number by 21 and then multiply it by 365, then we're looking at 28.75% Fantasyland numbers. Remember, that's the math we love to do, Fantasyland style. Okay, all right. So, and then that buys us some more time if we wanted to roll it again, if we wanted to mess around with the Googler. I don't know. I mean, that's essentially guaranteed money, right? But really the only guarantee would be the 55. 55 would be the guarantee. Sorry to be thinking out loud here with you as we do this, because again, we could let it roll. What would I have to do to go out and roll higher? So what if we went out 56 days to the third week of May? How high can we go to cover this debit? Well, we can go to 100. Could go to 105. Now it's confusing itself, or is it confusing me? Let me start over. Sorry. Thanks for your patience. What is SPY doing? SPY is going down, so let's try to close that again. Cancel order. Come on, Robinhood. Oh, you could do it. All right, back down to that Google call. Let's check it out again. Let's roll this position and see. Let's go out to that May 19th date to see what we can do. So we could go to the 105, still keep our asset, the 100 shares, but we would be trading it for 56 days, right? But we would also be trading up $6, so that'd be 600 dollar bills to get here. Let's do this. Let's go with the 330 credit here. Let's put the 330 credit in our pocket and just add $1 to that number. What do you think? Can we get that filled? What do we have to do to get it filled? Looks like that might fill right away. Covered call roll. Then the 330 then is guaranteed, right? That's in our pocket. Okay, there we go. $330. That's guaranteed with the potential of another $100 on the upside from the $99 strike to the 100, right? And remember, our original number is 92.47. So if we look at the 330 we just collected, we divide it by the 92.47 that is our original investment. That's 3.5% in 56 days. So if we do divide it by 56, and then we multiply that by the 365 number of days in a year, that'd be 23% on our money within an asset that we like, which is Google. So I'll take that. Hopefully that didn't confuse you, because it was confusing me along the way. Thanks for checking in on the Google Covered Roll. Have a great day, my friend.